In scenario 215, the ability to make additional payments to principal for a loan is added to the other business functions available in earlier scenarios. There's an automatic treasury function provided by the simulation. Treasury management involves a number of different activities. One of the most important of those is making sure that the company has sufficient cash to run operations. In the income statement, the net income is a long-run indicator that the company is profitable, but that doesn't mean that the company has sufficient cash to pay bills, to pay employees, and actually stay in business. In the simulation, the automatic treasury function requires cash to stay above $50,000. If at any point the company's cash account has less than $50,000, the treasurer will borrow money, and this is usually at a higher interest rate than the current loans that the company has. If the treasurer has to borrow money, you will receive an email in the simulation. Loans are made against assets of the company. At a certain point, the company no longer can get loans because all of the assets are leveraged. In other words, money has been borrowed against all of the assets, and banks will not be willing to loan money. In this case, the treasurer will have to sell stock at a discounted amount, in other words, at less than the value of the stock originally. This dilutes your ownership in the company and is a situation to be avoided. In scenario 210, an option was added to the results menu to look at general ledger account history. To understand ArborCrest cash flow over the year, we look back at the previous scenario and select cash and cash equivalents, then click on Draw Graph. This graph will show the cash balance over the year in simulation scenario 210. Notice that between January and April, cash drops. That's because we're building inventory to feed summer sales. Over the summer, the cash grows to a peak around September and then drops a bit from September through the end of the year because, again, inventories are being built for the following year. This graph can be very useful in predicting where cash is going to be over the year and help decide when loans can begin being paid, probably about beginning of May, and it'll be useful at the end of the year to make sure there are not too many payments against loan principal so that cash becomes short towards the end of the year and additional borrowing is needed. ArborCrest currently has 3 different loans that they are paying on with different balances. These loans are also made against different collateral items, buildings and improvement, machinery and plant and equipment, and land. The interest rates are different, the balances are different, and the payments are different. Payments are made automatically. For the building and improvements loan, it's on the 20th of the month. Machinery, plant, and equipment loan, it's on the 8th of the month. And on land, it's on the 4th day of the month. This scenario allows you to make additional payments, which will pay off the balance of the principal of the loan. Making an additional payment on a loan does not change the payment that's due, but it does reduce the balance and reduce the amount of that payment that goes to interest. To eliminate the monthly payment, the entire loan must be paid off. If the company has additional cash, it should be put to some purpose. Paying off loans is one good use of cash as it reduces interest expense over a long-run period. To make an additional payment to principal, there's a new menu path, Treasury, and under Treasury, select Pay Loan. This screen will show the loans that are outstanding, the interest rates on the loan, the monthly payments, balance due, and payment date. The highest interest loan currently is at 7%, using machinery, plant, and equipment as collateral. To make a payment on this loan, select the loan, and then enter the payment amount. Suppose the payment amount is $20,000. This is entered with no dollar signs, no commas, just 20000. Click Confirm Loan Payment. The pop-up window asks you to confirm the loan payment. Select OK. And now the balance on the loan, you can see, has been reduced to $28,232. And the additional payment is shown in the table below. To pay off the loan completely, select the loan, enter the balance amount, and confirm loan payment. Confirm in the pop-up. And now the loan is listed with a 0 balance, which means the payment of $4,326.34 will no longer be taken out every month. As an example, the machinery, plant, and equipment loan is the highest interest loan that ArborCrest has. This loan is nearly paid off and will be close to being paid off at the end of the year. Over the year of the simulation, without any additional payments to principal, $1,788 will be paid in interest expense. If this loan is paid off early with a payment of $27,770 in May, no more payments are made of the loan and no more interest is paid. Interest will be reduced by $619. This reduction in interest expense does not seem like a lot, but it only requires making a loan payment and moving cash from a bank account that's not earning significant interest to a payment against the loan. In addition, imagine that the company is making a 10% margin on its products. To earn $619 would require the company to sell $6,190 worth of additional product. So the savings of $619 is in fact significant. In addition, the savings would continue on year after year with the additional payment to principal. The next highest interest rate loan is the loan against the company's land. With the normal payment schedule over the year of the simulation, $4,179 in interest will need to be paid. If this loan is paid off early, for example in August, this will result in an additional savings of $1,346 in interest payments.